Okay, so we shall start the webinar proper now. So for today's webinar, we'll go through some of the company results for the stocks under our coverage, and then move on to a sector report on the Industrial REITs. We have published a report this morning as well on that. Okay, that's our disclaimer. And now we shall move on to Namly Press Metal, which announced their results last week. We still have a buy rating on Namly. Target price also unchanged at 52 cents. Forecasting a dividend of 2 cents for this FY. That would translate to a 5.5% yield based on the last close price last Friday at 36.5 cents. Namly announced their first quarter results. Revenue was flat, 1.1% growth. Gross profit was 34% lower. This was because of lower gross margin of 14.9% from 22.9%. This was due to two factors: a change in product mix that has a lower margin, and some foreign currency issue, which I'll talk about subsequently. EBIT was 58% lower year on year. This is a effect of the lower gross profit, despite being a lower operating expense as well. But EBIT actually was boosted by other income from foreign exchange gain. This relates to their contract for the aluminium frame with their major customer. So this foreign exchange gain, if you were to add it back actually at the gross profit level, you'll see that gross profit was, the margin actually maintained about 19%. So because they have a agreement with the customer that the customer will pay them back for foreign exchange gains. So this was recorded below the gross profit line. PATMI was down 6.5% year on year, but it actually exceeded our forecast by 3.4%. So the bullet point here says that negative surprise from lower gross profit margin, but PATMI higher than expected. So I've explained that gross profit, if you add back the foreign exchange gain, then you would have about 19% gross profit. For the business model, there's a lumpy revenue recognition because of project-based demand, and this results in volatile Q-on-Q results. So that's why we're keeping our full year forecast intact for now. The things about Namly to note is that it has a clean balance sheet and a cash hoard. Their net cash position, which is cash minus the total debt, is 13 cents per share now. So for 36.5 cents, actually 13 cents is in cash, and net debt to equity ratio is 2.7%, and they have a net interest income instead of a net interest expense. So actually the cash that they hold on the balance sheet, they are actually generating more interest income than the interest expense that they have. Okay, Linsin is not in the office today, so we'll skip for old Chang Kee. We'll also skip for Singapore ONG. Now we'll move on to Croesus Retail Trust.
Hi, good morning guys, Teng Hong here. I'll do a brief update on the results for Croesus. So Croesus reported their second quarter 1/7 results last week. For 1/2/17, revenue was up 42%. Okay, and this is primarily from contributions from the 4 newly acquired malls which were from October 2015 to May 16. So going down to the bottom line, DPU grew 7%. In between all the lines from revenue to DPU as a result of higher expense ratios, because some of these newly acquired malls, the expense ratios are higher than the original portfolio properties. So as a result of these higher expense ratios, higher finance costs from the issuance of the MTN in the middle of the year, you have DPU growing 7% to 3.6 cents. This is after factoring in the new units from the preferential offering as well. And then some other things to take note from the results briefing is that the new mall that was acquired in May 2016, Fio Asahikawa, the tenant replacement and tenant readjustments effort at the mall is still ongoing. This has been the case since acquisition. Last quarter, you saw that the NPI is actually 0 because it's in the middle of the tenant readjustment, so you have tenants moving out. So for that period of time, you're actually not earning income. But this quarter, you've seen that the NPI yield has improved to about 3%. So as the tenants gradually move in, you will see that this NPI number will start to improve. And then later on, I will put on a picture for you to see the state of the mall and some of the new tenants in the mall as well. So all in all, management is still confident of achieving an NPI yield on cost of about 5 to 6% as they originally stated during the acquisition. And then post 2Q, some of the things that happened is that in January, so the results were not affected this in January 17, the trust, Croesus is a business trust anyway, not a REIT. So in January 2017, they refinanced bulk of the debt that is due to mature this year. So they refinanced bulk of it at a lower interest rate, which reflects the kind of loosening monetary policies in Japan as well. So they refinance at lower interest rates. Annual cost savings will be about yen 152 million, and this works out to be about 3.3% of the annualized available income for distribution for 1H 17. So okay, over here you can see some of the stats for the malls that they have. You can see that the WALE is pretty long, 6.6 years. This is aided by the long master leases that they have for a few of their malls that they have master leased up to Aeon. And then, so for FY17, not much renewals left. FY18, 80% is also locked in. And then, okay, next you see some of the pictures as I mentioned, some of the new tenants that are coming into Asahikawa, some of the promotional events that they have carried out because of these new tenants moving in. And okay, so that's it. I will pass on to Jeremy to the banks.
Good morning. Okay, so the three banks have reported results. So before I go speak about the three banks, it's just a general flavor of what's happened this quarter. So previously we have written on the sector report talking about the challenges for the net interest income growth, and so for all three banks the growth has been weak. Year on year has come down. Also, the next thing would be in terms of liquidity, the banks have proactively managed the deposit side, so they would like to gather more liquidity. But on top of that, there was also some liquidity flows, regional liquidity flows into Singapore, which was not in what the management had expected. So in that sense, the build-up of deposits has been higher, and that also weighed down on the net interest income growth because of course the cost on your deposits in that sense against the volume, and in some cases for UOB and DBS the deposit rates has also risen up a little bit. So we're going to OCBC here. So the net interest income growth has fallen 7% year on year for 4Q16. The average rate on the non-bank loans have declined 16 basis points and has offset the increase in loans growth of 4.3%. So less the Barclays Wealth Management business in Hong Kong and Singapore, the loans growth would be about 3%, which is quite in line with the mid-single-digit percentage growth which has been guided earlier this year. The NPLs rose 814 million, or 33 basis points, and about 60% is actually contributed by the offshore oil and gas sector. So most of the non-performing loans in this sector are not caused by new names, but rather the existing names of customers who are experiencing unfavorable charter rates as the oil prices continue to languish at about $50 per barrel. And the volatility from the insurance business came from the volatile life assurance profit, and that is because the non-participating fund in the life assurance came in at about 71.2 million, which is lesser than the previous quarter of 83.9 and much lower than the year before 4Q15 of 163.7 million. And the volatile performance from this non-participating fund didn't help with to offset some of the weaknesses that we are seeing from the net interest income side of the business. So other miscellaneous stuff would be boosts from the boost in profit from the net gain of disposal of investment properties that helped to buff up some of the bottom line. And next would be DBS. Okay, so DBS also registered drop in year-on-year net interest income growth for 4Q16. So the average rates on the customer non-trade loans fell 11 basis points, and also the rates on the customer deposits have increased 1 basis points year-on-year. And one of the themes that they were talking about in terms of rates is that there seems to be less pass-through of the benchmark rates, say from the US side, over into the SOR and SIBOR. So this also has affected some of the how the rates of the loans can be priced. And also for the customer deposit side of things, when the deposits came in, of course, there's more of it. They had proactive management of the liquidity side, and so the rates on that also have marginally moved up in the fourth quarter of 2016. So the net effect, the loan to deposit ratio has come down to 86.8%, lower than 1 year ago, 4Q15 of 88.5%. In our sector report, we have spoken that DBS could be in favor of actually keeping a high LDR to create much higher efficiency in terms of net interest income earnings. So in line with that, actually the management in this quarter earnings brief has mentioned that they are comfortable to bring the LDR closer to 90%, around 90%. So we would expect that in that sense, DBS will continue to be aggressive in driving the efficiency for net interest income earnings. So the coverage ratio has in 4Q16 has declined to 97%, which is actually below the psychological level of 100%. What I meant by psychological level is that most people in the market would see 100% as the threshold. so it has fallen below that. That's owing to NPLs rising from 4Q15 of 0.9% to current 1.4%. And as a result, DBS has decided to use the divestment gains from the sale of PwC building of divestment gains of 350 million to be set aside for general allowance. This will bring the coverage ratio up to 104%. However, based on our estimates, we believe that the NPL should not rise beyond 1.4% by the end of this year, based on the gross loans of 314 billion. That is for the coverage ratio to remain at 104%. So this year we will also see some boost from the ANZ acquisition. So the DBS would be integrating 4 out of 5 of the markets that they had acquired by end of 2017. So the remaining 1 market would be probably by early part of 2018. What we'll be looking out for is the acquisition, the integration of this of the 4 markets in this for ANZ's wealth business this year will give DBS access to the credit cards business in Taiwan and Indonesia. Okay, finally, UOB. So same thing, UOB's net interest income growth has been flat year on year. The average rates have also fallen, but on the customer deposit side, the rates have risen. So the loans growth has been driven mainly by the retail side, home loans, that has given that extra boost. And the loans to deposit ratio continues to be at the same level, slightly higher at 86.8%, higher than 4Q15's 84.7%. The management has also guided that they would like to tap on wholesale funding to bolster overall liquidity. So in order to do that, they would be approaching the investor base in Europe and North Asia. So the decline in non-interest income was mainly due to a 98.8% year-on-year decline in net gain in investment securities and a 20.3% year-on-year decline in net trading income. This segment of the non-interest income has been extremely volatile and has not supported the overall business in a sustainable way. But the fees and commission income has registered steady growth, led by cards up 14.1%, fund management 13.5%, and wealth management 17.1% year-on-year. That ends my earnings report for the banks. And next, we will have the sector report on Singapore REITs.
Hi everyone, this is Richard again, I'm back. Okay, so now we'll move on to the next part of the presentation, which is the industrial subsector for REITs. We published a report earlier this morning, and we've actually upgraded the industrial REITs to a market weight or equal weight from underweight the last time. So this page shows the key points of the report. I won't go through them because I won't go through these bullet points here because I'm going into more details about them in the later slides. Here, this slide, what is showing is what I've just said. So we are upgrading the industrial subsector to equal weight on the optimism of bottoming of rents, but we are still maintaining our underweight view for the overall REIT sector. So just to make it clear, underweight for S-REITs, but within S-REITs, equal weight on industrial REITs. Okay, this is the most recent data from JTC was announced a few weeks ago. This is for the 4Q data. This is 4Q data 2016. There are a few things to highlight here. First one, look at this here. This shows the occupancy rate quarter on quarter. So this is comparing 3Q with 4Q. What you see is that generally the occupancy has ticked up in the fourth quarter of last year. The other thing that I want to highlight is these two numbers here for the rental index for multi-user factory, multiple user factory and single user factory. So you can see that quarter on quarter is fared the worst out of the other two types of industrial space, which is business park and warehouse. So if you recall last quarter, our view was factory space will be the hardest hit in fourth quarter. We said that warehouse will be worse, 2017 will be worse than 2016 for warehouse, and business park will be flat with a slight negative bias and no new supply. So you can see that this has materialized for factories. Factory having the worst, factory was indeed the hardest hit in the fourth quarter of 2016 with the highest Q-on-Q drop in the rental level. Okay, these are key takeaways from the quarter. We have three key takeaways. First, revisions, rental revisions were generally negative. Again, only a minority bucked the trend. So across the sector, all the industrial REITs had negative reversions except for three of them. So for two of them was Ascendus REIT and Mapletree Industrial, where on a portfolio weighted average basis they had a 3% plus positive 3% revision and a positive 2.1% revision. Note that this is a portfolio weighted average, so within their portfolio they still have a certain segment which had negative reversion. The other REIT which I didn't list here is Capital DC REIT. That was because they had one tenant who renewed and it was a positive 3% revision, but it's not, I didn't put it here because it's not really a big portfolio, it's just one tenant only. For second bullet point here, yeah, for all the industrial REITs where their financial year ends in December 2016, they all recorded fair value losses to their investment properties. There's only one exception, which was Viva Industrial Trust, where actually there was a positive revaluation upwards for that line item on the balance sheet. But this third bullet point is actually the most important one, and that is the central theme for our upgrade of the subsector view from underweight to equal weight, in that we are seeing a possible bottoming of rents, but nonetheless it will still be a tenant's market. So we track the asking rents. There's those brochures from the leasing agents of a basket of properties. We track asking rent, and we see that there's actually been a stabilization in the asking rents for the basket that we track, and the asking rent actually has not gone down at all. It's already held steady in the fourth quarter of last year, which is October, November, December. There was no change in the asking rent for these properties. Our channel check also suggests a fair amount of leasing activity on the ground and rents may be bottoming. So this part, you can see it evidently from the increase in occupancy, which I just showed just now already. And this was also corroborated by one of the REIT CEO during the results briefing. He also said that he thinks that we are close to the bottom as well for rents. Okay, so currently our house coverage, we have 4 REITs, 4 industrial REITs, and one of them we still have accumulate, which is Mapletree Industrial Trust. In this next few slides, I'll just go through some of the key highlights for each of the 4 industrial REITs that we cover. So first, for Cash Logistics Trust, currently the gearing is at 43%. It's a high gearing, and this is the key idiosyncratic impediment to inorganic growth. So the thing is that they cannot buy any more new properties, right, because they are close to the limit of 45% gearing. If they want to acquire new properties, they can't use debt anymore, and they probably have to do more equity fundraising again in order to acquire. So on the aspect, their inorganic growth is limited by the high gearing. And then now for organic growth, in terms of rental revisions, there's also limited scope for that due to oversupply of warehouses, and this will be mitigated by only 4.9% of expiry of their leases in FY17, which is this year. Also this year, in January this year, they divested one of their properties called Chang Kee District Centre 3. So that would not contribute any income to the portfolio this year anymore. And in the absence of capital, so if they do not distribute this proceeds from the sales, then we are expecting actually lower year-on-year DPU for all 4 quarters of FY17. Okay, moving on, Keppel DC REIT. So recently acquired 3 data centers, and we're expecting 30% higher gross revenue in FY17. So these 3 data centers, they're in Cardiff, Wales, Milan, Italy, and Singapore. But these acquisitions came at a cost. They had a 274 for 1,000 preferential offering in November 2016. This is in line with their long-term goal of keeping gearing at 30%. So they do not gear up their gearing and then do a big equity fundraising. What they do is they will do small equity fundraisings to keep on maintaining a gearing that's close to 30. Their portfolio is also expanding geographically outside of Singapore into Europe, as you can see, and this introduces country risk and currency risk exposure as well. But some of the currency risk exposure is mitigated through their hedging policy, where they hedge 2 years ahead for foreign currency denominated income. Next is Mapletree Industrial Trust. So the theme for it is firepower to acquire. The gearing at 29.4% is one of the lowest within the entire S-REIT universe. Here, this bullet point, you see that phase 1 of the Hewlett-Packard build-to-suit project already has been completed and is contributing to the income. Phase 2 is expected to contribute by 2nd quarter of this calendar year. The thing to note is that they have the other ongoing AEI, the Asset Enhancement Initiative for the Kallang Basin 4 cluster. So these 2 projects, the build-to-suit and the AEI, they actually use internal funding to fund these projects, and they did not go to tap the capital market by having rights issue or any preferential offer. How they did this was actually for some years they have been having their DRP, which is distribution reinvestment program. So that's how they managed to accumulate their cash on the balance sheet in order to fund these projects. Having said that, we also highlight some of the risk involved in Mapletree Industrial now. For FY18, they have 31% of leases expiring, and as you know, it's a currently oversupply situation. And half of these leases come from the flatted factory segment as well, and which is and we think that flatted factory is going to be one of the factory segment is going to be one of the laggards in terms of occupancy recovery. Lastly is soy build. So tough year ahead to backfill Loyang Way property. So as you all are aware, the tenant Technics Offshore had defaulted at their property and they vacated the property rate, and now they have been drawing down on the security deposit. They probably have about 3 months left of security deposit, and they are still actively looking for new tenants to fill up that property. Meanwhile, they had recently acquired Bukit Batok Connection, and this should just offset the negative effect of that vacancy. However, they also had to do a 1-for-10 preferential offering late last year in order to acquire Bukit Batok Connection. So this year DPU, we are also expecting lower DPU in all 4 quarters because of that dilution. Now this page shows the occupancy and the rental index for the overall industrial sector. You can see here occupancy has ticked up quarter on quarter. It's higher than the previous quarter now, and rental index is still lower year on year and quarter on quarter. You can see that the rental level has actually been dropping for about 4 years if you start from 2013 and going into 2017, so it'll be about 4 years. That's why we expect the negative double-digit rental reversions to continue into 2017, because you can see that the original signing rent is still higher than what the rent would be in 2017. Next, we move on to factory. We only focus on the multi-user and not the single user, which is a master lease, and there's because that one doesn't have much of a turnover. So we only focus on multiple user. So here again, occupancy higher quarter on quarter, and you can see that the rent level has been dropping for several years. That's why we're also expecting negative low double-digit reversions in 2017 for this segment. For business parks, occupancy higher quarter on quarter. Looking at this area here for the rental index, we think that for this year, reversions should be flat, as is about the same level as 3 years ago at the 2014 level. Warehouse, same thing, occupancy has ticked up quarter on quarter, but rental index has been going down for a few years as well. We're also still expecting negative low double-digit reversions in 2017 for warehouse. Okay, this slide actually just shows what is the new supply coming out in relation for the 3 different segments. So you start here, this is a factory, warehouse, and business park, and this axis is showing the years. So this is showing what is the planned new supply in 2017, planned new supply in 2018, and planned new supply in 2019. And you can see how much is coming out in relation to the other type, and also across the years. This table here is showing in percentage terms how many percent of new space is coming out relative to what was at the end of 2016. So like for example, factory here, it shows that in 2017 there'll be a 4.4% increase in new space over the existing space as at the end of December 2016. So what these bullet points here are showing is just the exact same things here. So this 4.4, 9.7, and 0.2 here is actually these numbers here. 4.4, 9.7, 0.2. So it's just saying factory space adding 4.4% to existing stock. Now the next level bullet point here, what is comparing is what's coming out in 2017 compared to the net new supply in 2016. So for 2017, there's going to be 49% more coming out compared to the net new supply in 2016. For warehouse, there's going to be 58% more than net new supply in 2016. For business park wise, it's a slightly different, it's a different story. It's in that from 2019 onwards, there's no planned supply already. Okay, now we move on to look at the PMI and industrial production. So so the dates here are different. This PMI is up to January 2017, while industrial production is up to December 2016. These are because they are coming from two different sources and they do not update the numbers at the same time. So Singapore PMI has been in expansionary mode since late 2016. Actually, this is in line with some of the major regions as well. Eurozone, USA, China, Japan also has been showing expansionary PMI since the late part of 2016. You can see that our industrial production also has been quite strong in the late part of 2016. There's some optimism on a recovery for PMI industrial production, but not before moderating downwards to a more sustainable level. So actually, specifically, we're referring to this area here where probably 21% is not sustainable and should moderate down to maybe close around this level would be better, more sustainable. And all these could actually signal the start of higher demand for industrial space. Nonetheless, we still highlight that the upcoming new supply is higher than the historical new supply. So there is still imbalance in supply and demand, but there may be some increase in demand going forward, and you have already seen that there has been an increase in demand through the uptick in the occupancy rate. Okay, so this first bullet point I've already talked about it. Basically, is saying that next year, or rather 2017, there's still a mismatch in supply and demand. Demand is lower than the historical average, and supply is higher than historical average. 4Q aggregate reversions extending to double digits did not come as a surprise. So we did say also that we were expecting negative double digit reversions going into 2017. We are still maintaining that to expect negative double digit in 2017, and this is unchanged from our previous expectations in our previous report. For factory, our view is that onslaught of factory space in 2017, multiple user factory space, or rather another way of saying is multi-tenanted buildings, likely to be the laggard for the subsector in terms of occupancy recovery. So I've talked about this bullet point where I say that last quarter we said 4Q 2016 will be the hardest hit, and I've shown you that they indeed were, and they had the highest negative change in rental index quarter on quarter. Now, for multi-user factory space in 2017, there's going to be 133% more than the net new supply that was made in 2016. And this is the reason why we think that of all the three types of properties, this will be the laggard in terms of occupancy recovery. And we are expecting low double-digit negative reversions for multi-tenanted factory in 2017. We are slightly less pessimistic than the last time where we said that it might go up to negative mid-teens. Warehouse, this quarter, fourth quarter 2016, there was a negative 14 reversion, and this was accented by the peak rent that occurred exactly 3 years ago in the fourth quarter of 2013. So planned supply in 2017 is 58% more than the net new supply in 2016. So 2017 is going to be worse than 2016 again. And we're also expecting low double-digit negative reversions in 2017 for the warehouse subsegment. For business park, limited new supply and expect flat reversions. Just now in one of the earlier slides, I showed you the chart for the rental index, and that's how we look at it and judge that probably will be flat. So we're expecting rents to remain stable Q on Q, but reversions to be flat. In our previous expectation, it was a flat reversions with slight negative bias. So we are less pessimistic also for business park now. So this is our top-down view. So we are equal weight on industrial S-REITs, on optimism of bottoming of rents. Although bottoming of rents, but that doesn't change the fact that actually there still is a demand-supply imbalance, but we are already seeing some stabilization in asking rents. And we also take this opportunity to emphasize the distinction between rental reversion and bottoming of rent. So the rent level probably this year may stop falling and start normalizing, but because the rent level is still lower than what was the previous signing level from 3-4 years ago, that's why there will still be negative rental reversions. For bottom up, Mapletree Industrial is our top pick for industrial S-REIT subsector. They have really demonstrated that they can grow organically with their build-to-suit and AEI project while simultaneously managing their capital structure. They did not have to have any rights issue or any preferential offering in order to fund this capex. Yeah, and then gearing is one of the lowest within the S-REIT universe. Here are some of the other characteristics of the REIT. So the weighted average debt maturity is 3.2 years with 2.8% and 17% of debt maturing in the current FY and the next FY respectively. 67% of the debt is hedged on fixed rate, and their interest coverage ratio is 7.8 times, which is higher than the subsector average of 5.3 times. This slide shows the quarterly results across the subsector. So these first few REITs are the one where their FY ends in March, and these are the ones where their FY ends in December. So looking from left to right, you're actually going down their income statement from their gross revenue or top line, then followed by the net property income, which is after property expenses, and then after the manager fee and interest and adjustment for non-cash items, you get the distributor income, and then finally the DP, which is distributor income divided by the number of units. So in summary, for gross revenue, I will only talk about gross revenue and the so-called bottom line, which is DPU. So for gross revenue, growth was driven by inorganic and organic growth. So for inorganic, it was obviously through acquisitions, and this was at Ascendus REIT, Mapletree Logistics Trust, Cash Logistics Trust, and Viva Industrial Trust. For their organic growth is the build-to-suit project for the HP at Mapletree Industrial Trust, and asset enhancement initiative at Mapletree Logistics Trust, where the Mapletree Logistics Hub Toh Guan has come online and started contributing as well. DPU impacted by dilutions from larger unit holder base. So for those REITs where DPU was impacted is because they did some equity fundraising, such as a rights issue for Sabana REIT, preferential offering for Soybuild, Capital DC and Viva, and a private placement for Cash and Viva. This slide shows the full year results for those REITs where their financial year ends in December. I won't go through these two bullet points because they're exactly the same as the previous slide, is word for word exactly the same. So the reasons for growth in gross revenue is exactly the same. The reasons why the DP was impacted is also exactly the same. So this slide shows some of the key metrics of all the 10 industrial REITs. It shows their occupancy, their weighted average lease expiry by gross rental income, weighted average lease expiry by net lettable area, their gearing, their weighted average debt maturity, their weighted average cost of debt, and their interest coverage. Okay, this shows the peer relative valuation and what it was 3 months ago and 6 months ago. So the main table here you see is as of 17 February 2017. This one here 3 months ago in November 2016, and this one here 6 months ago in August 2016. These are the tables that came from the reports that we published 3 and 6 months ago. So you just focus on the average here, which is here, here, and here. So in terms of price to book, actually there hasn't been much of a change over the last 6 months. But if you want to say there has actually the price to book has increased, but I don't think it's a meaningful amount. You can see also that trailing yield, actually there's been some compression for the trailing yield. This slide also is a graphical representation of the previous slide where we plot the trailing yield and the price to book. This is from February, and then here this one is 3 months ago, and this one is 6 months ago in August 2016. So graphically you can see nothing much has changed. The 4 largest market capitalized REITs, which is Mapletree Logistics, Mapletree Industrial, Ascendus, and Keppel DC, they still occupy the bottom right corner of the chart here, here, and here. Sabana REIT is still at the top left corner here, here, and then the other smaller REITs are just a cloud of, they form a cloud in the right in the middle of the chart. So nothing in this, in terms of their position, nothing much, relative position, nothing much has changed. Obviously, the changes is at the absolute levels at which they are at. Okay, and then we've come to the end of the presentation. We will pause here for questions. In the meantime, I'm resending the link for the survey. Please help us to complete the survey. Okay, first there's a question on Namly. The question is, Namly has very low average daily trading volume, market cap below 100 million. Is that a concern for huge bid-ask spread? There's no huge bid-ask spread. The bid-ask spread actually is the minimum, which is a half cent. So there's no bid-ask spread for that. Okay, next question about the link for the PowerPoint file. So the link is shown on the screen right now. That's the link to get to watch the recording of all the past webinars and to download the PowerPoint slides. So that link is the link on the screen right now. That's where to go to. Okay, when would the presentation be published on the website? Latest it will be there by Wednesday. That's the latest, but usually Tuesday will be there already. Latest Wednesday.
Okay, we have a question about why OCBC and DBS had a big jump in recent months. I think that could be attributed to the general shift to banking and finance companies. I mean, if you see the US banks on the global scale, they are also moving up. But of course, not all banks and finance companies are the same. We find that the Asian banks, I mean, in Singapore, I mean, let's say within this scope of Singapore banks, there's some operational headwind. So from here, the downgrade would be because the move up is not really in sync or does not reflect the challenging operating environment. So I mean, we cannot truly predict accurately how the share price will be, but I feel that the more it goes up, of course, it will be a lot more. The air will be a lot more dry. I mean, the air will be a lot more, a lot less. You see, so it should the kind of jump should be a lot less strong, you know. And if the fundamentals continue to be challenging and in the coming quarters, then of course the price should reflect that as well.
Hi, there's a question on Croesus, in that Croesus, being a business trust, is not obliged to pay out 90% of the profits as dividends. Is this a concern? I think that is a risk that investing in business trusts will entail. So for Croesus, in their IPO prospectus, they have committed to pay out 100% of their dividends, of their rental income as dividends, 100% until 2015. So IPO in 2013, they committed to pay out 100% until 2015, and they have also committed to pay out at least 90% thereafter. And I think what we are seeing on the ground until now is that since 2015, they have not paid out less than 90% of their income as well. So I think, despite this being a risk, it will still be better. Investors will still be better off buying a business trust which is not obliged to pay out 90%, but have better fundamentals, good more operators. Then, if you were to buy into a REIT, you buy into a REIT they're obliged to pay out 90%, but if the manager is not good, they acquire properties at unfair prices. These are so even though there's an obligation to pay out 90%, it's not going to be a good deal for investors. So I think investors should pay more attention to the fundamentals, the track record of the manager, whether the properties they're acquiring are good, or whether they can value add to poor performing properties and then revamp the properties into better performing properties, like what CMT did to last time it was called Illuma, and then they revamped it, they renovated it. Now it's called Bugis Plus. So I think these are the things to look out for when you buy into a REIT, and the business trust that risk is inherent, but then I think investors will be better off if you look at the fundamentals as well. Hi, there's another question on REITs, whether it's a good time to go into REITs now. We have a sector report on REITs 2 weeks ago, and generally we are underweight REITs for the next few FYs. The summary for our thesis on being underweight is that we are going through a period where there's going to be a Fed normalization of interest rates, and this is coming at a time where fundamentals are not recovering as fast. So comparing to the last rate hike cycle starting from 2004, we had rate hike cycle but very, very much improved fundamentals. Now you're entering into the same kind of rate hike period with poorer fundamentals. And that forms the backbone and the backbone of our thesis why we are underweight REITs at this juncture.
Okay, we have a question on any update on GNC. Okay, for those of you who've been following since we did the trading note, GNC released their results and it was, to put it mildly, less than stellar, so which is why the price tanked from there. Personally, from my point of view, I still think it is okay to hold on for it for the next quarter's results. The reason for the drop in their earnings and everything was because they're changing it to the one price system across all their stores as well as their online shop, which I think took a bit of a hit. That's why in comparison to the previous year on year, it fell by quite a lot. But if you were to take into account just the new GNC business proposals, then the actual drop in terms of their fundamentals were not as substantial as the on the surface result seems. So personally, I would say that I think that we'll wait again for the next quarter's results and see if there's a bigger turnaround. Keep in mind that this new GNC thing plan that the new CEO implemented has only had about 1 quarter to kick in, so it may not have substantially had as much of a turnaround, or rather the turnaround may not have come as fast as we had hoped. However, if it is closing very close to our stop loss price. But for personal wise, I would say that you can still, if you can afford to hold on for a while, I would say you hold on for a while. It should, I feel that the current correction is a bit of an overreaction. Yeah.
Okay, there's another question. What are the S-REITs inorganic growth for BTS, Mint, AIMLT? So I'll go back to this slide. Right, this is the one. I said inorganic growth and organic growth, that's how they grew the gross revenue. So for inorganic growth is through acquisitions, and acquisitions were at Ascendus REIT, Mapletree Logistics, Cash, and Viva Industrial Trust. For the organic growth, it was the build-to-suit at Mapletree Industrial Trust and the AEI at Mapletree Logistics Trust. AEI, the build-to-suit is the HP build-to-suit, and the AEI is the Mapletree Logistics Hub Toh Guan property. Okay, there's a question again on soy built REIT. So I guess I'll just reiterate that we're currently having a neutral rating. One of the is going to have a tough year this year, okay, because they need to backfill the Loyang Way property. It's currently vacant. It's a fairly big property. In the last quarter, they said that actually they are trying to get JTC to relax the type of tenants that they can have at this property. So and don't forget, this property is quite a big property. It was on a master lease. Now if they lease it out to several smaller tenants, that would be there'll be some negative effect from converting it from a master lease to a multi-tenanted lease, even if they could rent out the whole property 100% on a multi-tenanted basis.
Hey, hi, good afternoon, everyone. This is Peter on the line here. So I got a question about saying that, okay, REITs is not a good buy, so it doesn't seem that developers are better buy either because of the increase in valuations mainly due to a valuation rebound or M&A sentiment. So I would just like to just say something about the developers. So for developers, capital recycling is a very important aspect for them. And again, if you guys have been following some of the previous launches, we're still getting very good traction. I'm naming a few. Forest Woods by CDL. On the first day itself, 50-60% of it is sold already. So there is still, in a way, latent demand for property development. And at the end of the day, it's really about it's about first thing first, the launch quality as well as the quantum. So again, as I reiterate, the 60% total debt servicing ratio or 60% TDSR cooling measure is one of the most binding cooling measures there. But then again, if quantum is low enough such that people are able to take up loans, developments like these are actually still rather much intact. So again, last weekend there was a launch by Chip Eng Seng. The property name or the development's name is Grandia Park Residences. It's at Tanah Merah. It's at this point of time it's a pre-launch. So if you walk into a showroom, it's impossible for you to walk out because there's just so many people over there. So it means something. It's in a way it's an indication for demand. So again, now the property scene right now or the property development scene is challenged by the cooling measures that were put in place by the Singapore government. But think about it, the cooling measures are not going to stay here forever. In a scenario when the government decides to unwind it, it will get even more traction. So finally, coming forward, so just in summary, we think that the developers are becoming a more and more value buy. So look out for more for more of our calls and presentations.
Okay, there's a follow-up question for Namli. Actually, it's referring to the market depth and not the spread. Yes. So the market for Namli isn't very deep. So yes, that is one of the characteristics that you just have to accept and deal with if you choose to invest in this stock, because after all the market cap is one of the smaller ones. So the low liquidity um, is usually the characteristics of the lower market cap stocks. There's a question for Fraser's Logistics. Unfortunately, we don't cover that stock and not really looking at it, but I mean, all the properties in Australia seems like the income is stable, but of course you got to take into account the risk also, which will be currency risk. Although they do hedge it, but ultimately you are still uh, exposed to the currency risk because it depends on the timing of the hedging as well, and yeah, it depends on the timing that you execute the hedging. Okay, there's a new follow-up question again on Namli. The question is, Namli is already at fair value. Are your side looking at short to mid-term trading? Namli is not at fair value. The current price today, I think, is 36 or 37. Our target price is actually 52 cents. Our target price is actually a 1-year horizon, so it depends on what your short or mid-term definition is. Some people's short term is 2 minutes, some people's short term is 2 days. So, but our 1-year, our target price is a 1-year horizon, and I mean, if you look at it, let me try to elaborate a bit more on why we like Namli. Okay, so as you can see here, this we are saying that our forecast is 2 cents. This is based on a 50% payout where they have maintained around 50% for the last 4 FYs already. Based on 2% and last close price on Friday at 36.5, that will give you a 5.5% yield. If you look at other yield instruments like the REITs, you can get 5.5% yield as well, but you also risk a dilution if they have equity fundraising. Namely, they have not done any rights issue or even share buyback. They have a share buyback mandate. They're not even doing it. I think options for staff, they also have stopped giving options to staff as well. So there is so you do not get dilution from your holdings. We have always stated that Namli is a yield. You buy it for the yield. We have never projected this as a growth stock where they are going to do 10% higher revenue, 20% bottom net income, right? So we've always maintained that this is for you. There's a strong balance sheet with the cash on the balance sheet. The company is paying 50% payout, which is now 5%. If you compare with a REIT, you may get diluted. The REIT, they are paying out 90% and you're only get 90% of the cash and you're only getting 5.5% yield. Here they're paying out 50% payout and you're getting 5.5% yield. 5.5% yield. So that's why we are saying that this, we have always been saying that normally you buy for the yield, and even with getting the 50% payout, you get 5.5% yield from the dividend. You are still an owner of the cash that is retained on the balance sheet as well.
Okay, that's a question on Hong Leong Finance. Unfortunately, I guess I can't comment on that because it is not within the scope of the three local banks. I've not looked at the other finance companies in detail. So I'll refrain from commenting on that. Thanks. Okay, thank you everybody for attending this webinar. We have come to the end as we don't have any other significant questions. Please reminded that there's the survey there, surveygizmo.com. The link is up in the chat box. Please enter please fill up the survey. Thank you very much.